Hi, I'm Michael Yardney, and last week I wrote a blog about 4 surefire ways to lose money in property this year, and it must have struck a chord as tens of thousands of investors read it, and many emailed me asking further questions. Now this got me thinking about other ways I've seen investors get it wrong. You see, the unfortunate truth is most investors fail to reach their objective of financial independence. Statistics show that half of those who get involved in property investment sell up in the first 5 years. And of those who remain in the game, less than 10% own more than 2 properties. As I've often said, property investment is simple, but it's not easy. Now that's not a play on words. It means there are proven systems and strategies that have helped create wealth through property investment for many Australians. However, too many investors do the wrong thing or get swayed by promises of overnight success by those messages we keep getting in our inbox. Now, in my last blog, I suggested you should avoid buying secondary properties. I suggested avoid buying off the plan or new homes in new estates, or trying to buy properties with options or in the United States. All those things were smoke and mirror games. But today I'd like to look at another 7 ways you could lose money in property if you're not careful. The first way is not having a strategy, not having a plan. Most Australians spend more time planning their holidays than they do planning their financial future. The problem is, if you don't have a strategy, it's just too easy to get distracted by the so-called opportunities that keep cropping up, many of which don't work out as expected. Just have a look at all those investors who bought off the plan, or in what they hoped would be the next hotspot, only to see the value of their properties underperform. My recommended strategy for financial independence is to build a substantial asset base over a 10 to 15 year period by purchasing high growth properties and by adding value to them through renovations or redevelopment. Over the next years, you add more properties to your portfolio as your cash flow and as your equity allows you to. Then in time, you slowly lower your loan to value ratios and start living off the equity of your properties. The next way people lose out and will make mistakes is not reviewing your property portfolio, because property isn't a set and forget affair. To be successful, you must treat your property investments like a business and regularly review their performance. Of course, you can't easily swap properties or reweight your portfolio like you could with shares, but that doesn't mean you shouldn't regularly review your portfolio to see what you can do to improve or upgrade your properties. When was the last time you checked to make sure you were getting the best rents, or that your mortgage was appropriate to the current times? Maybe it's time to refinance against your increased equity. Maybe you could use the funds to buy further properties, or maybe just to top up your financial buffers, those that you set aside for a rainy day. To gain financial independence, it's important for you to own the sort of properties that are going to allow you to take advantage of the new property cycle we're going into. Remember, over the next few years, some properties are still going to grow strongly. They're going to outperform others. But if you own secondary properties or real estate in areas that are unlikely to benefit from strong capital growth, it may be worth selling up or replacing them with the type of property that will help develop your long-term financial independence. So review your portfolio. The third way is not managing your risks. You see, many investors don't understand the risks associated with property investment, and therefore they don't manage them correctly. Smart investors don't just buy property, they buy time by having sufficient financial buffers in their lines of credit or their offset accounts, not only to cover their negative gearing, but to see them through the ups and downs of the property cycle. Another way sophisticated investors protect their assets is to buy them in the correct ownership structures. That allows them to legally minimise their tax and to protect their assets. I found that most wealthy people own nothing in their own names but control their assets through companies or trusts. And of course, you must also protect yourself by having adequate income protection insurance and life insurance. The fourth mistake to watch out for is thinking you can do it all on your own. Because the property markets have been booming, some investors think they can just buy almost any property and it's going to be a great investment. Unfortunately, this is far from the truth. In my opinion, less than 1% of properties on the market are what I call investment grade. And just like in the last property cycle, many investors are going to lose out. Don't be afraid to ask for help, but make sure it's from an advisor, somebody who's got your best interest at heart and is paid by you, not by a salesman with their loyalties lying to the client, to the developer, to the vendor. Buying property is a complex process, and if you're the smartest person in your team, you're in trouble. Of course, I think a property investment strategist should be at the centre of your team, coordinating the others. but then some would say I'm biased. However, I know that my team at Metropole Property Strategists have helped thousands of ordinary Australians. We've helped them create significant wealth through property. We've been involved in over $2 billion worth of property transactions. Fifth mistake is believing of these get-rich-quick schemes that say it's easy to become a millionaire overnight in real estate. I've found some investors look for that one big deal that's going to make them rich overnight. Others try to make money by trading properties. Unfortunately, the buy, renovate and sell strategy they learn from programs like The Block that's on TV just doesn't work in real life when you've got to pay tradesmen, tax, interest. Remember Warren Buffett's great quote. He said, "Wealth is the transfer of money from the impatient to the patient." Sixth big mistake is not doing sufficient due diligence and groundwork. Even though some capital city property markets are booming, that doesn't mean you can just afford to buy any property out there and pay any price. This year the markets won't cover up those types of mistakes. Not doing your homework can cost you a lot of money. So can falling in love with a property for all the wrong reasons. As an investor, the only good reason for falling in love with a property is that the numbers stack up, that it fits your plan, that it has more upside potential than issues, and it's going to help you meet your goals. So don't let your emotions drive your decisions. That's what home buyers do, not real estate investors, not strategic investors. Seventh big mistake is buying the wrong property. While almost every property increases in value over time, some rise significantly more than others. To build financial freedom, you need to own the right type of property, one that grows in value sufficiently to enable you to borrow against your increasing equity, give you funds to purchase the next property. However, when you ask investors why they purchased their property, they're going to say things like, "Oh, it's close to where I lived," or "It's close to where I want to holiday. I want to put my kids in there one day. I want to retire one day." They're all emotional reasons for buying property. And while that's the way people buy their homes, it's not the right way to buy an investment. Instead, I suggest you use my four-stranded strategic approach to selecting a top-performing investment property. I look for properties that are going to have wide appeal to owner-occupiers, and I buy properties below their intrinsic value. That's why I avoid new and off-the-plan properties which come at a premium. I look for areas, which have got long, strong capital growth, but are going to continue to outperform the averages because of the demographics in the area. This will be an area where there's more owner-occupiers wanting to live there because of the lifestyle choices, and one where the locals are prepared to, but more importantly, can afford to pay a premium price to live. The third strand is I look for properties with a twist, something unique, something special, something different, something scarce about the property. And finally, I look for a property to which I can add value. I can manufacture some capital growth through renovations, through refurbishment, through redevelopment. To help make 2015 your best year in property, I'm going to suggest you become financially fluent by learning from the mistakes of others rather than your own. I'm going to give you insights in how to take advantage of the year ahead, how to make 2015 the best year for you at my one-day trainings I'm conducting around Australia in 5 states. So I look forward to seeing you at my National Property Market and Economic Update seminars. Or if you'd like to have a chat with our team at Metropole, why not give us a call on 1300 20 30 30, or just go to metropole.com.au and organise your own one-on-one session with one of our property strategists to review your portfolio or to see what we could do to help you get the property market.